Hi, Wilson. This is Marie Concert, real estate broker with Janelle Scott. Wilson Mack, can you introduce yourself?
Hi, everyone. I am Wilson Mack with the Mack Mortgage Group. I've been an independent mortgage banker for nearly 20 years, and it's an interesting time right now, is all I have to say.
Yes. Interesting time for us as well, real estate agent. But you know what? I still have clients who need to sell right now, and I still have clients who need to buy. So using all COVID-19 protocols, we're doing everything we can to continue to serve our clients.
Mhm.
The one thing I wanted to talk with you about today, Wilson, is this forbearance program that the governments have been encouraging the banks to set up to help their clients, their borrowers who have maybe lost their jobs due to this pandemic. Can you speak to that a little bit? Explain what that means.
Yeah, absolutely. So a forbearance plan is something if, say, there was job loss due to being laid off, reduction of hours, reduced income, any impacts where you're no longer able to make your mortgage payment anymore, you actually call the servicer. So you get a
Yeah,
loan through a
who
lender.
is the servicer? Can it be the lender or it's a third party sometimes? Tell us
Yeah,
more.
it can be both, but typically the servicing is sold off. So where you get your statement and where you send the check to or your auto bill pay, that is the mortgage servicer. So they are allowing people, if you're calling them, to get anywhere from a 3-month forbearance to a 6-month forbearance. And if 6 months isn't enough, then you can actually, I've heard you can go up to 1 full year.
Wow. Now, my my question here is something that I'm hearing a lot is that people feel sometimes that it's kind of free money, it's a waived mortgage payment, but that's not the case. It's not a waived mortgage payment, is it?
No, so this is where I think a lot of people are being misled. There is a small business loan that's being offered, and a lot of that can be a grant, and then a certain portion of that can be forgiven. However, that does not include the mortgage. So how it works is you might not pay a payment, let's just pick a number of 3 months. So for 3 months, you skip that payment. However, if you know what a balloon payment is, everything will be due upon the 4th month because you forbeared 3 months. So on month 4, you actually owe 4 payments. So it's a balloon payment. Everything is
Okay.
due all at once.
So on that fourth month, you basically owe that fourth month's payment, right? The regular mortgage payment plus the 3 months that you didn't make payment on. So that can
Correct.
be a huge bill to pay at that point. How do late fees and penalties work in that scenario?
So with the forbearance
Potentially.
program, the servicers are supposed to waive all the late fees. So it's just going to be the actual mortgage payment that typically consists of principal, interest, taxes, and insurance. So the whole mortgage payment. So in that example, it's the 3 missing months plus the month that's due on the 4th month, so a total of 4 payments.
Got it. And what happens with the credit bureaus at that point?
So that's what's very interesting. I like to give guidance and tell everyone out there, you have to be educated in this because nothing is free. So if you think about it, if they're not able to make their payment for that 3-month forbearance, how are they going to come up with that balloon payment
Right.
in month 4?
Right.
So it's it's misleading because if you can't make that and then none of that money is just forgiven, it's actually going to lead you down a path of, maybe some people are familiar with what's called a loan modification. So
Right.
there is when you permanently adjust the terms of your mortgage from what you initially signed when you got your mortgage for your home, either when you purchased it or even when you refinanced it. Maybe you refinanced it for a lower rate, or you refinanced it for cash out.
Got it. Could you put those past payments that the payments that were in forbearance, could you add them to the end of your mortgage potentially?
That's really up to the servicer. So
Okay.
it possibly could, but it's the issue is that there's three events that can happen if that balloon payment doesn't get paid all at, in our example, month 4. The first one is the loan modification, where the terms are modified.
Okay.
The second thing is that, well, you just might not, the client might not be able to afford the house anymore, afford the payments. So they're in a position where they have to short sell the house. So they sell the house at probably at a reduced cost and then pay the servicer less than what the balance is owed. So that's a short sale. And then worst case scenario is the third one is a foreclosure, where they don't even go the short sale route and they just don't pay, they don't do anything, and then they are forced to leave the home via an eviction. So those three things are what are called negative credit events. So either of those three will lower your credit score, as well as impact you if you need to refi, if you just did a loan modification, or if you got out of the house and you needed to purchase again, you might have to wait a minimum of 2 all the way up to 7 years, because that's what's called credit seasoning for a negative credit event.
So this sounds, it's a very serious decision that people have to make. Now, people have their job. Some individuals are in very difficult situations. So what I'm hearing you say is that they should be contacting their servicer or their lender if the lender is servicing the loan. But in any case, make that contact, because everybody is in a unique situation, and what may apply to your neighbor may not apply to you, and vice versa. So you have to be very cautious and make a decision that's right for you. Yes?
Yes, you're absolutely right, Marie. And it's just, even say it's the same servicer, your neighbor and you have the same servicer. However, they might say, well, you know what? How long have you had unemployment? Or have you been laid off? Or whatever the particular situation is, because typically there is what's called a loss mitigation department that reviews the file, and then
Okay.
each file is going to be looked at differently.
Differently, yeah. And what I'm hearing you say as well is, if you are in a position to make your mortgage payment, do it.
Absolutely.
Now, I suspect with our exceptional circumstances that the government may want to step in and set up something to help homeowners weather this crisis over time. In 2008, with this particular crisis, the government did come up with a particular program. It's probably fair to assume that if we come down to this, the government may install something similar to this, and maybe even start with what worked back in 2008. And that was the HARP program. So although there is no indication at this time that this is the path they will take, if the government is going to encourage the lenders to work with homeowners and borrowers in order to go through this crisis. And if they want to reactivate the HARP program. Can you tell us just a little bit the highlights of the HARP program and how it worked at the time?
Yeah, so typically what happens is in a HARP program, it was only for conventional mortgages that were backed by either Fannie Mae or Freddie Mac. So if you still had that mortgage to provide some relief, a lot of things were waived, and a lot of times an appraisal was not needed. They just lowered the interest rate to make things easier financially for the homeowners.
So they had a lot of tools in a big toolbox called HARP at the time, but that program did not come about overnight. No. And I have to assume that if the government intent is to work out something, it's not going to happen in a month. It's not going to happen in 3 months. It will probably take a little longer. And I guess I want to conclude here this conversation by saying it really comes down to a case-by-case basis. So every homeowner, if you are in a difficult financial situation, basically, the takeaway here is to call your servicer and discuss your particular situation with your servicer.
Absolutely. And then there's also one more thing I would like to point out.
Sure.
If the client purchased the home or refinanced the home, say a month ago, and they haven't even made their first payment, and they try to get a forbearance program right away without making the very first payment, it might exclude them from anything because the very first payment wasn't made.
Ooh, there's no history of good payment history on the loan. That's an excellent point.
Yeah, because right away there was no payment, so it's going to be looked at very negatively. So at a minimum, I would say make the first payment so you fit within the rules, and then if you really have to utilize that tool of a forbearance, also when you call the servicer, ask that they have any predefined terms. So things such as maybe there is a repayment period that's spread out over 5 years, 8 years, whatever it might be, as long as it is not one of those 3 negative credit events such as a loan modification, short sale, or foreclosure. Because if it's predefined, that means they should guarantee that there's no way that it's going to impact credit.
Got it. Now I want to end on a positive note here. Some people fear that this is 2008 all over again. So I want to share a graph that you shared with me. I want to put it on the screen here and let you talk a little bit about it. So this is information about where we're at in home ownership in today's world.
Right. So a lot of people have been asking about, is this going to be a 2008 all over again? And this is absolutely totally different. The issue back then was that a lot of homeowners did not have any skin in the game. Basically, they were not putting any money down. They had zero equity. So they were more than willing to walk away from the house, either doing a short sale or doing a foreclosure, just walking away.
They had no skin in the game.
There's no skin in the game. However, since that time, a lot of people have been, because the loan programs are totally different. The loan programs of what were really popular, such as 80/20s, where they had no money down, and then they could just put any type of income amount that they made monthly.
Yes.
Regardless of where they worked, they could potentially buy $1 million house when if they were to show the paperwork.
There was a lot of trust in the information provided in loan applications at that time. Things have changed. There's a lot more checks and balances today. and people have to indeed verify. I mean, you guys are verifying everything as lenders. And what that slide is showing is that Americans have more skin in the game today. Homeowners have a lot of equity in their home on average, which is huge.
Absolutely. So no one's going to want to walk away from that. So
right.
with 30% their homes are owned free and clear, 26.7 have at least 50% of equity. That is equity is what I always call as a forced savings plan. It's a way to build wealth. So why would someone want to jeopardize that? So that's why when someone's looking at the forbearance, they have to be very, very careful.
Right. So thank you so much, Wilson, for making the time to do this sit-down interview here with me and explain a little bit more about that forbearance program that may sound too good to be true for some people, but always read the fine prints and ask the right questions. So thanks for your guidance today. And we shall do this again, as today things are changing daily with this current crisis. I hope everybody is staying safe and healthy, though.
Yeah, absolutely. And Marie, thank you for having me. And I think this is a great service that you're providing your community, because education is key. If you can educate someone, then you empower them to make the best decision they can for themselves and their family.
That's the key. Thank you so much, Wilson.
All right.
Take care.
Be safe.
Bye. Bye.